The dollar just hit a 4-year low, and if you hold cash, this could quietly destroy your purchasing power. Let that satisfactorily sink in, because most people won't understand what this means until it's too late. The world's reserve currency, the backbone of global trade, the asset every central bank holds as their ultimate safety net, down over 1% in a single day, lowest level since 2021. And when the president was asked if the dollar had fallen too much, he said the value of the dollar is great. Pause for a second. This part matters more than people realize. The man who controls American trade policy just told you he's fine with your dollars buying less. Now watch carefully. This isn't just a currency move, this is a signal. Gold just hit a record above 5,080. Oil surged to a 4-month high. The euro broke 120 for the first time in 4 years. The Australian dollar spiked to a 3-year high. And here's the part that should keep you up at night. While all this is happening, the Federal Reserve is walking into a rate decision under criminal investigation of its own chairman. A sitting Fed governor faces removal. A successor is being nominated in weeks. This is where people get blindsided. When the world's most powerful currency falls this fast, while the central bank is under political siege, and the administration shows no urgency to stop it. That's not volatility. That's not noise. That's a regime change in motion. This mirrors what happened before the 1970s dollar crisis, when confidence cracked and the entire monetary system had to be rebuilt. By the end of this, you'll understand exactly why this outcome was predictable, and what happens to everyone who ignores the signals. This isn't about politics. This isn't about ideology. This is about incentives. Pure, cold, unavoidable incentives. I've spent decades watching currencies, watching capital flow, watching what happens when the people who control money face pressure they can't escape. And I'll tell you something simple. When you see the dollar falling, gold surging, and the central bank under siege, all at the same time, you don't ask if something is wrong. You ask what's breaking. Here's the answer. 3 data points, 3 pressure points. Each one alone is significant. Together, they create a lollapalooza, a compounding of forces that makes the outcome almost mathematically certain. But the third data point is the one that turns concern into certainty. And this is where the pattern becomes impossible to ignore. Here's the first number, 96.27. That's where the dollar index sits right now. The lowest in 4 years, down over 1% in a single session. The sharpest sell-off since Trump's tariff blitz rocked markets last April. Now here's why this matters to you personally. The dollar index measures the U.S. currency against 6 major rivals: euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. When this index falls, it means the dollar is weakening against all of them simultaneously. Think about what that means for your daily life. Everything America imports, electronics, cars, clothing, food ingredients, gets more expensive. Your dollars buy less, even if your paycheck stays the same. And here's the part nobody is paying attention to. This isn't happening in a vacuum. Jan von Gerich, Nordea's chief markets analyst, explained it clearly. Last week, when there seemed to be a flight from the U.S. in general, you had equities falling, treasuries taking hits, and the dollar falling. Now it's more of a dollar story. Pause for a second. This part matters more than people realize. Last week, everything American was getting sold. Stocks, bonds, currency, all of it. That's not normal profit taking. That's capital flight. This is like the foundation of a skyscraper starting to crack. You don't see it from the street, but the engineers are panicking. Now it's concentrated on the dollar, and this is where it gets worse. When asked whether the dollar had declined too much, Trump said the value of the dollar was great. Guy Miller, chief market strategist at Zurich Insurance Group, translated what that really means. Despite the falls in the dollar over the past 12 months, it was coming from a very rich level, and even today is not particularly cheap. Consequently, I don't feel the administration is in any rush to try and arrest the decline. Read that again. The administration sees no urgency. The dollar is falling, and the people who could stop it, they don't want to. If this continues, the cost of living quietly rises, even if your income doesn't. When incentives align like this, outcomes stop being opinions and become math. and this is where the system starts cracking. Keep this in mind, it connects to everything that comes next. Now, the second data point, this one isn't a number, it's a situation, and this situation changes everything. The Federal Reserve is holding a rate decision meeting today. Rates are expected to stay steady. But here's the dangerous part. This meeting is happening while a criminal investigation is underway targeting Fed Chair Jerome Powell. An evolving effort is in motion to fire Fed Governor Lisa Cook. A successor to Powell is being nominated in May. Pause for a second. Let that satisfactorily sink in. The chairman of the world's most powerful central bank, under criminal investigation by his own government. Jan van Gerich put it simply. The most interesting thing about the Fed tonight is that Powell could now say something more on this political pressure, because he's refrained from all of that so far. Think about what that means. Markets are waiting to see if Powell will finally acknowledge the pressure. And here's what most people don't understand. Central bank independence isn't just a nice idea. It's the foundation of currency credibility. Think of it like this. The Fed is supposed to be the referee in a game where trillions of dollars are on the line. When investors trust that the referee makes calls based on rules, not politics, they trust the game. When that trust cracks, capital moves, and it's already moving. The dollar's 4-year low isn't happening in spite of Fed uncertainty. It's happening because of it. Now the pattern becomes impossible to ignore. This isn't a coincidence. It's a system signal. But the third data point is where concern becomes certainty. Now the third data point, and this is the one that makes the outcome inevitable. 3 numbers that tell one story. Gold, record high above $5,280 an ounce. Brent crude, 4-month high above $68 a barrel. Euro, broke 1.20 for the first time since 2021. Australian dollar, 3-year high above 70 cents. Now here's the trick. All of these assets have one thing in common. They're priced in dollars. When the dollar falls, everything denominated in dollars becomes cheaper for foreign buyers. Gold gets more attractive, oil gets more affordable. Other currencies gain relative strength. This is mechanical. This is arithmetic. And here's where the math turns into fate. When gold hits a record high on the same day the dollar hits a 4-year low, that's not coincidence. That's repricing. The market is telling you something. It's saying, we trust the rock more than the paper. Pause for a second. This is where it gets personal. If you hold savings in dollars, a bank account, a money market fund, cash under the mattress, those dollars now buy less gold, less oil, less of everything priced globally. Your wealth is being diluted in real time, even if your bank balance looks the same. And this is where the system starts cracking. European central bank policymakers are flagging growing concerns. The euro's quick appreciation is worrying them. They're warning it could drag inflation down below their 2% target. Think about that. The ECB is worried the euro is getting too strong because the dollar is getting too weak. This creates a feedback loop. Dollar weakness forces other central banks to respond. Their responses create more instability. More instability drives more capital into safe havens. Gold rises, dollar falls further, the loop accelerates. When trust in money cracks, everything priced in it must reset. Why these 3 forces together make the outcome inevitable. Now let's connect the dots. Because this isn't random. This is a pattern. You have the dollar at a 4-year low, and an administration showing no urgency to defend it. You have the Federal Reserve under political siege, its independence questioned at exactly the wrong moment. You have every dollar-denominated asset repricing, gold, oil, and rival currencies all moving against the greenback simultaneously. 3 different pressure points. 3 different sources, 1 direction. When incentives align like this, the outcome stops being a guess and becomes a mathematical inevitability. Now let's invert. What would have to happen for this to reverse? The administration would have to signal it wants a stronger dollar. The Fed investigation would have to disappear. Powell would have to project total independence and confidence. Geopolitical tensions would have to ease globally. Does that sound likely to you? I didn't think so. The math makes this outcome unavoidable. So, where does this end? The dollar found its footing today, up 0.37% to 96.27. But sentiment remains fragile. Markets are bracing for possible coordinated currency intervention by U.S. and Japanese authorities. The Fed decision comes tonight, with Powell potentially addressing political pressure for the first time. And gold sits at record highs while the world watches. Here's the sentence that tells you everything. Guy Miller at Zurich Insurance said it directly. I don't feel the administration is in any rush to try and arrest the decline. That's not speculation, that's strategy. A weaker dollar makes American exports cheaper. It makes American debt easier to manage. It shifts the pain to trading partners holding dollar reserves. And who pays the real price? You do, through higher import costs, through eroded savings, through a cost of living that rises even when your income doesn't. This isn't noise. This isn't politics. This is a monetary shift. This is confidence in America quietly breaking, slowly, methodically, but unmistakably. The ECB is worried. Asian central banks are watching. Gold is screaming the answer. And by the time most people realize what's happening, the repricing will already be irreversible. So what do you do with this information? Three things: cold, logical, no emotion. First, understand your dollar exposure. If your wealth is 100% denominated in dollars, savings, investments, income, you're making a concentrated bet that this trend reverses. That's not a plan. That's a gamble. Second, watch the Fed tonight. If Powell acknowledges political pressure, expect more dollar weakness. If he projects confidence and independence, expect a temporary bounce. Either way, the structural issues don't disappear. Third, recognize what gold is telling you. When the oldest store of value hits record highs while the world's reserve currency hits multi-year lows, that's not noise. That's the market pricing in a new reality. None of this is advice. All of this is arithmetic. I've spent my whole career trying to understand incentives, and right now the incentives are screaming. The administration wants a weaker dollar. The Fed is under siege. Capital is rotating into hard assets. When trust in money cracks, everything priced in it must reset. This isn't about morality, it's about simple arithmetic. Subscribe if you want to think like capital, not like the crowd. I'll keep following the numbers so you don't have to guess. Life moves pretty fast. If you don't stop and look around once in a while, you could miss it entirely.